Hey everyone, welcome back to Corporate Decoder, the place where we dig into the fine print of corporate filings. Today we're cracking open SPX Technologies' latest quarterly report, a document so exciting it makes reading your electricity bill feel like a thriller. Okay, maybe not, but who knows what we may find in there. Buckle up, because we're about to see if SPX is soaring or just spinning its wheels. Are they raking in the dough, or is trouble brewing? Let's find out. Right off the bat, this is a Form 10Q. Meaning it's a quarterly report. The period ended on March 29, 2025, so this is a snapshot of how they did in the first 3 months of the year. They've got about 46.7 million shares of common stock floating around as of late April. This number is important for calculating earnings per share, which we'll get to soon. Okay, let's dive into the good stuff, the financials. First up, the condensed consolidated statements of operations and comprehensive income, basically the income statement. Their revenues for the quarter were $482.6 million. That's up from $465.2, so being more stuff. Operating income, which is like the profit they make from their core business before things like interest and taxes, was $66.6 million, a slight bump from $64.6 million the previous year. But check this out, their income tax provision, what they actually paid in taxes, went from $1.9 million last year to $6.2 million this year. That's a big jump. Ultimately, their net income, what they get to keep after all the expenses and taxes, came in at $51.20, just a bit over the $49 million they had last year. Basic income per share, the profit for each share, is $1.10 versus $1.07 last year, so a little more profit for each shareholder. Next, we have the balance sheets, a snapshot of what the company owns and owes. Their cash and equivalents, how much money they have handy, is $177.80 million, which is nice to have, up from $156.9 million at the end of last year. Accounts receivable, net, which is money owed to them by customers, is $319.6 million. Inventories net, which is like stuff on shelves, is $308.1 million. This went up versus the end of last year, which could be a good sign they expect to sell more, or a bad sign things aren't selling as expected. Goodwill, an accounting term for the value of a company's brand and reputation after an acquisition, is at $950 million. This can be a tricky number, as it can disappear if an acquisition doesn't pan out. Their long-term debt is sitting at a hefty $872 million, up significantly from $577 million at the end of last year. Total stockholders' equity, which is the value owned by shareholders, is $124 billion, up from $1.38 billion. Alright, last of the big three, the statements of cash flows. It explains where cash came from and went. Net income is $51.20. Depreciation and amortization, a non-cash expense, is $27 million. They spent $304.11 million on business acquisitions. We knew they bought KTS, but this really puts the cost into perspective. They borrowed $393 million and repaid $98 million under senior credit facilities. So this means they are using debt to finance something. Their net cash from operating activities is negative at $710.9. This is not good and warrants investigating. Alright, after the major three tables, we usually go to notes to see what is really going on. The KTS acquisition is mentioned. It cost them $342.4 million to acquire Accession Technology Solutions, a company that specializes in digital interoperability and tactical networking solutions. It services mostly the defense industry, and more acquisitions might be coming. In accounting news, they will have to disclose more segment expenses in the future. Here's a list of how they split the KTS deal, with a whooping $105M going to goodwill. They also include pro forma numbers as if they had owned it at the start of last year, with revenue pro forma to $491 million. The identifiable intangible assets acquired consist of technology, trademarks, and customer backlog of $79.8 million, $6.7 million. ASU 2024-03 will be effective for annual reporting periods beginning after December 15, 2026. They wound down DBT operations. It was a business in South Africa, no longer part of ongoing operations. Here is a disaggregation of the revenue per segment. Let's scroll down. Okay, so the HVAC segment revenue is $323 million this quarter, and the detection and measurement segment did $159.6 million. The contract asset are 37.5 million, an increase of more than 100% since December. Nothing important happened with the leasing moving on. HAC segment made $73.9 million while detection and measurement generated $36.6 million. They had some special charges due to restructuring, basically laying people off or having severance. Here's the breakdown of the goodwill for HVAC versus detection and measurement. Debt-wise, they had a fair amount to repay or borrow, a whooping 375M in revolting loans. They are always involved in contingent liabilities, which is lawsuits and other legal problems. Oh well. The effective tax rate was 10.7%, mainly from benefits from the stock-based compensation. And that's it. The CEO and CFO signed it off. Tupty. Now let's step back and look at the big picture. SPX Technologies is in a transition phase. They're clearly betting on acquisitions to drive growth, KTS and Sigma and Omega being the most recent examples. The core business is doing okay, but those acquisitions are really juicing the numbers. The big question mark is the debt. $872 million is a hefty amount, and it's something to keep an eye on. They need those acquisitions to perform well to justify that level of borrowing. On the good side, their backlog in the detection and measurement segment looks very nice, and that increase should probably be something we will be watching. The company does mention the risk from tariffs and global conditions, which are very common in filings these days. All things considered, I would give this report a cautious thumbs up. They are taking risks to grow, and so far it's paying off. And with what we heard from management, they are pretty capable of keeping everything together. Okay, that's all for today's corporate deep dive. If you found this breakdown helpful, don't forget to hit that like button, drop a comment with your thoughts, and subscribe for more financial forensics. Until next time, stay decoded.